I hope you now have a thorough understanding of how you can conduct fundamental analysis on stocks and the companies that issue said stocks. Now let's move on to the other major type of analysis, which is technical analysis. So technical analysis looks only at, well, the technical side of investments. In other words, this analysis looks at the historical performances of a security, and using that tries to predict which direction the security's prices will move in the future. And using this prediction, the investor will make investments to profit from price movement speculations. Now, let me break this down with an example. Let's say we're looking at an asset, let's say X, and are trying to find out or predict if the prices will go up or down. Now we'll look at the performance chart of this asset and notice that the price has increased incrementally over the past 7 days consequently. Now to get an idea of what might happen the next day, we look at the past cases when X has increased incrementally for 7 days in a row. We take all these data from these situations and examine what happened on the 8th day. If the data shows that in most cases, say 90% of cases, the prices of the assets increased again on the 8th day, we take that as a key and make our predictions that the price will also increase this time as well, and so invest in that asset to benefit from the price increase. So really, technical analysis look only at how the trend was and make predictions thereon. They barely go to see the underlying reason behind why the prices increased or fell. One of the things that technical analysts do to analyze technical data is studying price charts of securities. These are graphs of sort that show depictions that track and show the price movements of a security over a period of time and give information on the number of trades and trade volumes that happen during that time. In these price charts, technical analysis also look for trade trends. So for example, if the price, say, of a stock falls to a low point and then goes up a little before falling back down to a similar low point, the technical analysis would say that there is a support level at that price. A support level is a price where there is enough demand for a stock that it is unlikely to go down further than that. So investors monitor support levels in securities as well to make investment decisions. Then technical analysis also pay attention to something called moving averages. What they do is they track the average price of a security, like a stock, over a certain period of time, let's say 200 days, to make predictions about its future movements. And then with whatever the result is, they derive conclusions. They make predictions and of course they invest accordingly. So technical analysis, or rather technical analysts, use plenty of tools to analyze their price charts and the trading patterns, on balance volumes or OBVs, accumulation or distribution lines, average directional indexes, Arun oscillators, moving average conversion divergences or MACDs, relative strength indexes, also known as RSIs, are some of the tools to name a few. These are all tools that very professional traders and investors use to profit from very minor price movements, and that happens even within a day. So we're not going to get into this in that part, or rather we're not going to get into that in this part of the course. And nevertheless, you might wonder which analysis in this fact is the better one. To be very honest, the answer to this question has been something that has been the subject of debate among investors for quite a while now. Now, there are some very famous investors who have profited from using fundamental analysis and have therefore strongly advocated for it. So, for example, there's Benjamin Graham. He's a very strong fundamental analyst, or rather analyst, and the author of the very famous investment guide called The Intelligent Investor. So he had his own mutual fund company called the Graham Newman Corp, and between 1936 and 1956, the year in which he retired, it was reported that the firm made at least 14.7% in investment returns annually, as opposed to the 12.2 average returns of the stock market. This is actually one of the best long-term tracks of the Wall Street history. Then another strong advocate of fundamental analysis, who has also seen many of the biggest investment successes in history, has to be Mr. Warren Buffett. He's too well known as someone who makes investments, or rather investment decisions, based on fundamental analysis. If we take investors who profited from technical analysis, there is Mr. Jim Simmons, who was a mathematician who later opened his own hedge fund firm. It's also been reported that during his career as a hedge fund manager, Jim Simmons managed to make a returns of 66% on average on investments he made over a period of 30 years. The analysis he used, though, is kind of a branch of the technical analysis called quantitative analysis. Now, this method of analysis and other algorithmic investment strategies, which he developed himself, are how he did most of his trading. And due to his success in trading using quantitative analysis and using the massive profits he made, he was called the quaint king of trading. Back to what we were discussing, there is no one answer as to which analysis method is better. The ideal answer is actually both. To be specific, if we take the logic behind fundamental analysis, although a security that is fundamentally strong is poised to increase in value in the future, it doesn't mean that the price will miraculously start going up when you start investing in them. So after conducting a fundamental analysis and deciding on the securities you want to invest in, you can maybe use the technical analysis to identify the exact time to buy or invest in them. But as beginners and investors who aim to invest for the long term, this is the extent to which we recommend you do a technical analysis, just to monitor the highs and the lows of the securities. Relying only or solely on technical analysis is something that is more suitable for expert investors and maybe day traders, because experts understand the patterns and their underlying implications of the securities themselves. And as for day traders, well, since they're only looking to make profits for the trade spreads, technical analysis works best for them as well. Now, we of course are looking to invest in good securities that will build our wealth and protect our net worth even through times of downturn. So the best way to do this is to research your investments thoroughly through fundamental analysis, while you can also support that research with a little bit of technical analysis to identify the buying and selling signals and execute them accordingly. That way you can eliminate a considerable amount of risk in your investments.